Have you heard of BDCs? Are they too good to be true? Would you trust 15% yields on a BDC or any stock? Is that just a big scam or what? I'm the late fire starter, which stands for financial independence, retire early, and I got a late start to my financial independence, but the fact is I'm on my journey now, and you are here with me, which I really appreciate, and I just want to encourage you to get your start on it, whether it's paying off debt, whether it's starting to increase your savings rate, whether it's investing, whatever it may be. I focus on two main areas. I focus on cash flowing rental properties, and I do a video on that every Saturday. And I focus on dividend investing, and I focus on that on Wednesdays. You know what I would really like for you to do right now? If you haven't already, go ahead and subscribe to the channel and join me on my journey. Also, I did some research on this to really give you a good background on BDCs. I haven't seen another video on YouTube that explains the history like I'm doing or really going into detail with BDCs as I am. And so if you appreciate my effort, go ahead and hit that like button for me as well. Today we are focusing on dividend investing, specifically in what are called BDCs. BDC stands for Business Development Company. They are similar to a REIT, which is a real estate interest trust. And so REITs and BDCs both get great tax benefits if they pay out their profits to their shareholders. And so BDCs don't have to pay taxes if they give at least 90% of their profits in dividends. That is why both REITs and BDCs have higher than normal dividend yields because they have to give so much of their profits to their stockholders. Business development companies got their start in the 1940s with an act to help revive the economy. So what happened is, and this may sound familiar, is basically there was a huge pandemic, the Spanish flu. That was followed by the Roaring '20s, which was a great time of economic prosperity, which was followed by the Great Depression, which was a horrible time economically, and the stock market crashed and everybody lost a ton of wealth. That was followed up by the New Deal, which is what gave us things like Social Security, Medicare, and other things. But during that time, there were some other elements to help spur the economy. And one of the things that was implemented were these business development companies. This was an act to focus on helping grow those middle market companies. Those companies that aren't big enough to be in the stock market, but maybe aren't small enough to be called a startup. And so you have this middle ground of companies that need investment, but maybe they aren't traditional lending qualified. They can't go to a bank and get money because maybe they don't have enough to show, or they cannot sell their IPO stock. They cannot go public and earn money because they're not making enough. They're not big enough. They're maybe in that $5 to $100 million range. They are doing well. They're a legitimate business and they have growth aspects, but they need to find other lending avenues. Today, the most common known avenues that are meeting this market are venture capitalists. A BDC is basically a venture capitalist company that you and I can invest in. They're also kind of like a bank that you and I can invest in. So they're private lenders in a way. They lend money to these middle market companies. They also invest in companies and get stakes in them. The most famous venture capitalists today are those people on the Shark Tank. Look at this interaction between a company that's looking for investment from venture capital, looking for someone to invest in their company and take ownership. They look at two different ways to do that.
4 sharks are out. Kevin is Stefan and Eve's last chance to make a deal for their skincare company, Creole Essence.
I'll give you the $400,000. I want 37%.
Oh. Okay, thank you so much for that offer. Would you do $400,000 for 20%?
Never, never, never. This has risks.
All businesses have risks.
Look, I'm impressed by you. Now we're having a tough love discussion. It's about money. I want to make money.
Mr. Wonderful, would you be interested in thinking through this, doing a royalty deal?
royalty.
Yes.
That brings a tear to my eye. I'd like to hear what you have in mind.
15 cents for every bottle sold.
So I don't have any equity, it's just a royalty?
It's just a royalty deal.
Tell you what, final offer. I want 25 cents royalty on every unit sold in perpetuity and 5% equity, and you have a deal.
You have a deal.
Let's do it.
Wow, what a turnaround. I didn't see that coming.
If you notice that they started out with a normal venture capital, I will give you this much money for this much stake in your company. I want to own 20% of your company. I want to own 30% of your company, and I'm going to give you this much money for it. They end up with a mix of, I'm going to invest in your company for ownership, and I am going to loan you money. I expect a return on that investment through some sort of payback. In this case, it was a royalty. Every product sold, Kevin O'Leary got a portion of that product. And over time, he's going to make his money back and then some. So he got a split, part ownership of the company and part getting his money back through a royalty. BDCs are very similar. They will lend money at a higher interest rate and get the money back, or they will invest in a company and get a share in that company and hopefully hit it big. There are a lot of other things they do. If you think about a bank, how many things a bank does that you and I never even think about to make money. BDCs are doing all kinds of things to make money, but the two main things to think about are they're investing in companies. They are a lender. So when we invest in these companies, we either win or lose as they win or lose. Right now, there are a total of 44 BDCs that you and I can invest in. So there's really not a ton, but there's actually quite a few. The dividend ranges greatly from around 5% to about 18%, so there's a wide range. The share price of these BDCs ranges from under $2 to over $30. So you have a wide range of prices, of dividend yields, of sizes of these BDCs. There's also a couple ETFs that will invest in all of the BDCs or multiple BDCs for you if you just want to get into the BDC market and get a piece of everything. There are ETFs you can look at as well. I personally invest in 2 different BDCs right now. And what I'm going to go over with you today is one that I really think I should start investing in. The main BDC that I invest in is called Apollo Investment, AINV, Apollo Investment Group. And so you can see on their website that they focus on primary loans, first lien, meaning that if something happens, they have the first rights to recover their money. I loan you $100,000 on a property that is worth $100,000, and then somebody else loans you $20,000. They're in second position. You default on that property, and I have to sell the property. I sell the property for $100,000, get all my money back, and the second position gets nothing because there's nothing left. And so first position is really good. It's key to have. And so they're showing that a majority of their loans are first lien position. That's great. The other thing I want to point out is that they focus on a floating rate loan. That's important. As lenders, banks do this. Do you know that if you give a bank $100, that gives them the right to loan out $500 or something like that? I need to look this up. But anyways, banks work on leverage, every single one of them. The way they make money is they're allowed to lend out on paper. It's not even real money. It's crazy. Money is nuts when you look at it. It's kind of scary. But so I give a bank $1,000. That allows them to loan out a multiple of that. So even though they only have $1,000 in their bank, they now have lent out $5,000 off that $1,000. That is leverage that banks use to increase their cash flow. They borrow that money for say 1% and then they charge you 5%. And so they make 4% on that money. They're making money off other people's money. BDCs do the same thing. And so the spread, if it's 1% to 4%, there's a 3% spread that they make. With a floating rate, they take, say, the prime rate and they add a portion. So maybe it's prime plus 3%. When the interest rate goes down, it's cheaper for them to borrow money to lend out. It helps them in their costs. When interest rate goes up, now it's more expensive for them to borrow money, but it increases their revenue. So by having that floating rate, when it goes down or up, that spread remains the same. Because they're borrowing money to lend money, this is a very predictable profit margin on any loan, anytime. So right now, these BDCs are getting beat up. Companies are falling. Companies are going bankrupt. Companies are closing, especially in this middle market area that BDCs focus on. If you have a lot of defaults on your loans, you lose big time. This happened one other time in 2008. So I just want to look at a chart of a few main ones. Let's look at ARCC. This is a BDC that and just me, I'm not a financial guru or expert, but this is a BDC that I think is something I want to start investing in. I want to put some money into this ARCC. So I just wanted to compare the charts of 3 different BDCs. So let's look at ARCC first, and let's pull out the whole chart. Let's look at the whole lifetime of this stock. So as you can see, it dropped huge. It grew, and then dropped huge in the 2008 housing market crash, right? And that was a financial crash. So it grew, and then precipitous drop, and then it continued to recover until COVID drop, and then it's finished around there. Not as high, but it's recovered somewhat. Let's compare that to what I have my money in, which is AINV Apollo. It actually went up higher than Ares and then dropped at that 2008, but the recovery after 2008 with Apollo never was as good. It stayed way below. And then with COVID drop, it still didn't recover as well. Now, the biggest and maybe oldest BDC, most well-known BDC, is Main, M-A-I-N. So when I plug that into the chart, you see a same thing where there's a 2008 drop, it continues to grow, and it's doing so much better than the other two until COVID hit. It drops way more than the other two do because it's got further to drop, but it still ends up higher in regards to the others. So when you look at it, Apollo has lost, in the lifetime of the stock, 86%. That's horrible. Ares has lost 15% over its lifetime, and that's not so bad. Main, as you can see, is the only one that's made money, and if you had it for the lifetime of the stock, you would be up. Why won't I invest in Main? I think Main is a little overpriced, personally. I think that when you look at the price to NAV, it's actually the most expensive out of all the BDCs. It's perhaps one of the safest, but it's also one of the most expensive. And what you're gonna get for that stock price is about a 9% dividend yield, which is still great. So it's still worth investing if you want a safe one that's been around forever, that you know you can trust. But as you can see over the lifetime of the stock, there are lots of volatility. So this is more of an income stock. This isn't a growth stock. You're not buying in this to double, triple your money. You're buying this to have a very high paying regular dividend yield. So it's more for income than it is for growth. That's true with all BDCs. If you look at Ares, they are a pretty good price. I think they're selling for about what they're worth, maybe a little teeny discount. And their dividend yield is about 11% right now. When you look at Apollo, they are beat down. They are so beat down. They just reported their most recent financial results and they beat expectations. And so they look like they're doing better than people thought. And so they've actually jumped up in the last couple of days. But I still think they're at a huge discount. And as a result, their dividend yield is about 15%. So it's a really great dividend yield, but of course, there's risk in all of these. A great website, if you want to explore some of these BDCs, is bdcinvestor.com. So as you look at this site, it's going to list all the BDCs, how much they're currently selling for. You can look at the price per NAV rankings. You can look at the top dividend yields. You can look at charts. And so this is a really cool site for BDC research. And so I would encourage you to check it out. I would never put all my money in BDCs. It's not a core holding, but it really helps get my overall dividend yield up. And when I'm trying to get to that 6 to 6.5% overall dividend yield, and my core holdings are at 4%ish, I need some of these things to really lift my boat higher. Thanks for watching. Thanks for coming along my journey. Once again, if you haven't subscribed yet, go ahead and subscribe. And if you've made it this far, I really like you, so go ahead and like me back. Have a great day and stay safe. Get going.